of us tune out when we hear words like banking, banking union, or acronyms like CRR, NPL, CET, because we think it doesn't impact our lives. I'm Maitreyi Sitharaman, and this week Real Economy is exploring how the alphabet soup of European banking regulation is changing. Is it going to make our banks safer, lend more to you and I, and ultimately be less of a burden to us, the taxpayer? Well, we all know that since the crisis, banks have had a tough time lending to businesses, to you and I. So I'm here in Brussels to find out what these new regulations are going to do to encourage banks to lend to the real economy. And I'm going to put that question to Valdis Dombrovskis. He is the Vice President of the European Commission, the man in charge of the euro and our financial stability. What are these new proposals? Can you explain them?
One is to ensure that if things go wrong, taxpayers are not the first in line to pay for banking sector mistakes. And second, to preserve the diversity of Europe's banking sector and ensure lending to the wider economy, putting stricter capital and other requirements to the banks, ensuring that even the biggest banks, what are called globally systemically important banks, have enough own resources so that they can be resolved if things go wrong, and at the same time looking how we can facilitate lending to the economy, lending to the small and medium enterprises.
Is there anything specific you think will help citizens be a little bit more reassured that our banks can lend more?
Some of the specific proposals like leverage ratio, like net stable funding ratio, like fundamental review of the trading book, those measures are there to reduce risks in the banking sector. And then while reducing risks, we also need to see how we facilitate lending. And one of the areas is through targeted amendments on, for example, reducing capital and other requirements on banks when they are lending to the small and medium enterprises, or when different financial sector players are financing either infrastructure projects or infrastructure companies.
Well, these proposals have come after in-depth consultation with European banks. They've spent the last couple of years checking the regulation boxes with stress tests, capital requirements. But SMEs are still having a tough time getting loans, and investors seem unduly concerned about the health of these banks. So Guillaume Desjardins set out to find out why.
Wait. I thought banks were okay after the stress tests in July, and they were being monitored and regulated under Europe's banking union. Makes me wonder if my bank is okay. All right, everyone seems calm in there, but then why do investors seem all worried? Since the beginning of the year, bank shares have been going up and down like a yo-yo. Investors have priced in elections, oil levels and macro influences, but contagion from underperforming Italian banks and the biggest European banks being fined are making investors like Pascal Bernachon uncertain. If we look inside the banks, their P&Ls are in the green.
Banks' profitability is significantly under what it used to be. Why? On the regulation side, there is a negative factor. Secondly, companies have started to find funds, not through the banking system, but directly from the markets. You had, at the same time, I would say, all the mistakes from the past. You are showing Deutsche Bank. Let's not forget that it was given a so-called $15 billion fine.
Fines that stemmed from too little regulation to what many now think is too much, making sure banks have safety nets like capital requirements and controlling non-performing loans to ensure taxpayers won't have to bail them out is blocking banks from lending. Among the European banks, there are 13 that are so big, so important, that we can't let them go down. They are called systemic banks. This means that in case of a problem, the taxpayer will be the one paying. So how do you balance taxpayer protection with lending and economic growth? We went to the European Banking Authority, the stress tests masters.
Knowledge about the banks is the key, as long as those banks themselves have addressed legacy problems and are geared towards a future and a sustainable future. All of the studies show that it's only well-capitalized banks that are able to lend into the economy in good times and bad. A thinly capitalized bank is not able to lend into the real economy except by excessive leverage, which is highly volatile, highly risky, and can end up damaging the economy.
It will be a test for proposed European rules to see if this time banks can actually work for the economy.
Still with us is European Commission Vice President Valdis Dombrovskis. These new proposals, some are anticipating that banks are going to be forced to raise billions in new debt. How is that going to impact their lending behavior, and how are national governments reacting?
First, it's clear that for banks to lend to the real economy, they also need to attract this financing in the first place. The proposal on total loss absorbing capacity, it tells that banks must raise their resources in a way that it can be bailed in. So what we are saying is that there should be enough creditors for the bank whose loans can be used to absorb bank losses if this becomes necessary. That is what is called the bailed in. It's as opposed to the bailout by the taxpayers.
Do you think these new proposals are going to allow European banks to be in a stronger position, and under what rulebook?
Position Europe is taking that completion of Basel III should not lead to the overall substantial increases of the capital requirements. First, we need to have a strong and stable banking system and not to go back to the model which was there before the crisis, where there was lots of deregulation and banks were taking excessive risks. In several countries, we still have high levels of non-performing loans in the banking sector. And we work closely with those countries to actually resolve this problem of holding back banks from new lending.
Do you think this is finally going to convince everybody to get on the European Deposit Insurance Scheme, the ultimate backstop to protect the taxpayer?
We already have single supervision, we have a single resolution mechanism, and European Deposit Insurance Scheme is a third pillar for the banking union. We hope we'll be able to reach agreements as regards our risk reduction measures and also as regards European Deposit Insurance Scheme.
Mr. Dombrovskis, thank you for your explanations. And we do understand that the banking alphabet soup can be quite intimidating. So do go onto our website where we've curated some more simple explanations for you. Thanks for watching. We'll catch you next time.